so much time, Um, the name of the course is Financial Markets and Derivatives. We are looking at the second assignment, whose due date is 12th of May, 2025. And I want us to consider question number 1. One of the most important instruction is instruction number 3. It says you have to answer, question 1, and it should not be more than 4 pages of the solutions. Not more than that. Okay? Not more than that, which means it should be less than that. It would be 2.5 pages, or it would be 3 pages or something, but not really more than that. That's a question that we have. Yeah, I am displaying the question on the screen, and I guess you are able to see it. And let me now read in your hearing. Question number 1 is reading, and I read in your hearing. The company is a prominent institution investment firm with a diverse portfolio assets, and it is seeking to expand its investments into debt market. The other name for debt market is bond market. The idea is to better manage risk and generate stable returns, right? That's why they want to invest into debt markets. Now, what has happened is that they have observed some, fluctuations in the equity holding. Now, the investment team of the company has decided to add the bonds to the portfolio, especially with a focus on the government and the corporate debt instruments. That's what they have done, right, in their investments. So they have considered, they have looked at the equity part of it. That is the holding of shares. It's quite fluctuating in terms of the interest rates. So what they have decided to do now at this point is just to embark on, an investment that is to diversify and also invest in government bonds and, corporate bonds. Now, this move is a strategic thing. So the strategic move is aimed at, enhancing the overall diversification and risk management of the portfolio. At the same time, pursuing yield opportunities that may be available in other asset classes. Now, our investment team has a particular interest in understanding the characteristics of the bond markets, which is also called the debt markets, right? They want to understand. Now, as they are unfamiliar with the, with the concept of the bond investing and the associated risks and returns associated with the bonds. In short, they want to invest in bonds, but they don't really understand how the bonds work, all right? Now, further, they are keen to explore how interest rates movement affect the valuation of the bonds and how bond prices behave in relation to changes in the market conditions. That's what they want to do. It is said that the government bonds, which are viewed as, relatively safe investments due to their, backing by the government, the company is also considering corporate bonds. You get what I mean, eh? They know that there are government bonds on the other side. Now, the government bonds are quite safe, are relatively safe, but they're also considering the corporate bonds. Now, when you look at these are perceived as offering higher returns, yeah? They offer higher returns, the corporate bonds. You can't compare with the government bonds. But the issue with the corporate bonds is that they may come with more risk, The higher the return, the higher the risk because of some potential of defaults. These guys could even default at some point, the corporate guys, the corporate bonds. The company, the Investcorp team, the team has been, tasked with conducting thorough research on bond markets. They have to understand the different types of the bonds available and how the bonds are valued. And they also have to understand the potential implications of interest rate changes on their portfolio. Should the interest really change, what could be the impact of that on our portfolio, right? This is the task or the assignment that has been given to the team. Now, as part of the research, the investment team has identified two specific bonds. They have gotten two specific bonds. One is a government one, it has the face value of 10,000 kwacha, the annual coupon rate of 5%, and the maturity period of 10 years. The tenor is 10 years. They have picked this bond. It's one of the bonds actually they are using to study and analyze. All right. Let's go to the second one. They have also picked a corporate one because they want to diversify. They want to invest in government bonds and also the corporate bonds, those that are issued by corporations or by companies. They want to invest in that. So the corporate bond issued by a high-rated manufacturing company with a face value of 1,000 and the annual coupon rate of 6%, just 1% different. And in terms of the duration, the corporate bond is 5 years. Now the bond is actually sold at a discount. It is sold at 950. Its face value is what? 1,000, but it is selling at 950, which means there is 50 kwacha discount. So it is being sold at a discount. That's what we say from finance. Now, the investment team that we have has raised the concerns of how raising interest rates could impact the value of the bonds. The value of the bonds shall not remain the same, interest rates change, all right? The corporate bonds especially, they do really respond to these changes. And this may be very sensitive to the credit risk and also, of course, as relative or compared to the government bonds. Now, to help this team make an informed decision, the investment manager has asked the following question. And these are the questions that have been asked so that the team may really understand the bond market. So in short, colleagues, we're just looking at the bond market, basically. There's nothing much. We just want to look at some of the principles that underpin the bond market, of which previously, I remember having a conversation with you. I even took you to the Bank of Zambia website where we explored practically how the bond market works. Shall we answer these questions that the investment manager raised? Question number one, the investment the company is particularly interested in understanding how the bond or debt market functions and how investing, in bonds can diversify the portfolio. Additionally, the team wants to explore how these markets contribute to the broader economy and the financing of both government projects and corporate activities. All right. One, explain the characteristics of the debt or bond market and how they contribute to economic growth and investment opportunities. Okay, so we want to quickly explore the bond market, the characteristics of the bond market. Okay, now the debt market. Are you able to hear me clearly? Can you see the screen? We are now starting answering this,
yes.
Discussing the solutions. Okay, the bond market. Number one, we said that it gives a fixed income, isn't it? The income is fixed. There's fixed income. That's what we said. The bond will offer predictable income in form of the coupon payments, right? Usually in form of coupon payments, isn't it? That's what we explored. We said coupons are fixed from the word go. And again, the bonds, they carry the risk. Let's call this credit risk. It's another characteristic. The bonds, there is a risk, but these bonds that we're looking at are not just government bonds. We are looking at the bonds as a whole, including the corporate ones. So there is credit risk, where the bonds carry this risk of default, especially the corporate bonds, okay? They carry the risk of what? Of default. These are characteristics. That is to say, if the issuers of these bonds can default. To default simply means they have not given you back your money when they failed somehow. In terms of liquidity, the bonds trade actively, and others may actually be illiquid because these differ, okay, in terms of tenors, all right? The bonds that are, for example, 2 years, 3 years, they are said to be liquid, less than 5 years, very highly liquid. But there are those bonds whose tenors are greater than that, like 7 years, 10 years, 15 years bond. Those are said to be a bit liquid somehow. So, but we do know, okay, we do know that the bonds can be sold on a secondary market, depending on the efficiency of your capital market, all right? So that is to say, the bonds basically can be sold. Yeah. So what can we write here? The shorter tenors, all right? By tenors, we mean period. The shorter tenors bonds are said, these are said to be highly liquid as compared to, you know, or relative to the longer tenors bonds. Okay. Anyway, we can still go ahead and contribute. The question is still not done. It's saying, how do these contribute to economic growth and investment opportunities? How do the bonds contribute to economic growth? How do the bonds really contribute to that? Anyone who wants to pick that one from what we said last time? How do they really contribute? You can just say one. Okay. The bonds are used to fund, you know, we used to fund infrastructure and the other public sector projects, fund government and the corporate projects, corporate projects, because I'm trying to balance between a corporate bond and the government bond. The government bonds, they are used to fund that one. So they can really do that. They're really good. They offer investment vehicles and they do promote, you know, savings, and they facilitate capital formation because they do allow, you know, long-term borrowing. So the bonds facilitates capital formation. Capital formation. What do we mean by capital formation? We mean that it enables the corporations or the government to borrow, right? They could actually borrow and add to their capital structure, right? That is for the corporations. Okay. You can still really explore and add some more points. Let me comment on the second part of the question. He's saying, can you evaluate the role of debt markets, the role the debt markets play in financing both government and corporate projects? What role do the bond market play in financing? It's more like a reference of the previous question, part one of the question. Basically, we had already done this, but we can still go over and say this. What role does this work? Let's start with the government.
They provide
yes, go ahead.
The provision of financing you borrow money, you lend money to the government, there'll be capital that will be provided, hence facilitating that economic expansion.
All right, all right. So they provide what? They provide, what did you say? Funds? The government bonds.
They provide capital to the government.
Yes, they provide capital, right? They do provide capital to both the government, of course, in this case. That is to say, the funds who fund, the roads, we are building the bridges, we are building the hospitals. As the New Dawn government, we are also building schools, and we are trying to do quite a lot. Oh, by the way, I'm non-partisan. I'm just neutral. Let me say the government is trying by all the means. Okay. Let's proceed. And what else? This can help us to manage fiscal deficit. You know what we mean by fiscal deficit? The times when we don't really have enough funds as a government, and then we are having what you call fiscal deficits, and there is a downturn actually in our economies. All right. So these can be used to stabilize our economies, especially in the times of downturns. You remember the business cycles you learned from macroeconomics, eh? You get what we mean by downturn. They can even stimulate, public sector employment, right? Public sector employment, yeah, because when we place all those investments, then we are able to expand that area. So more people could be employed, among others. You can even add your own points here and just, add corporate projects. With corporate projects, I think this should be a bit similar again. Yeah, the corporate bonds, are used to do what? To finance what? They finance acquisitions. You know what an acquisition is, right? To buy a company, the already existing company, you buy it. That's called an acquisition. They are used to finance acquisition, research and development, and add to working capital, basically adding to working capital as well. Okay, working capital. That is done. The corporation uses the money for that. And again, the bond market can still help the companies to diversify. Yeah, they can diversify the funds beyond equity. Yeah, and again, they can take advantage. Remember that we said that the bonds are not really, it's debt as far as the corporation is concerned. So being debt, there is some tax advantage, yeah? The bonds, they have some tax advantages. They even attract more investment in some strategic sectors. You could have all those things. Because with the bonds, since it's debt, treated as debt, there is less of, corporate bonds, right? Not government bonds. I'm talking about corporate bonds. Yeah. So there is some incentive that it gives you on taxation, because you have to pay firstly all these interests before you can declare the taxable income. I think that is clear. You've gotten that. Okay. Plus many more points could actually be added. It's the same conversation we have always been having. Now, the team, I'm on B, the team at InvestCorp is considering both government bonds and the corporate ones for inclusion in their portfolio, and they need to understand the different types of debt instruments and their respective risk. returns, maturities, and liquidity, right? These are the four most important areas or aspects of debt market that need us to take into consideration. The bond market or the debt market, right? You have the risk, the returns, the maturity, and liquidity. And this actually will help the team to decide how much of their portfolio should be allocated to each type of the bond. Now, what is required? The required. We are required of discussing the different types of the bond instruments, the debt instruments, not just the bond, the debt instrument available in the bond market. We have to highlight the key features such as the risk, the return, maturity, and liquidity. We are to include the comparison between the government bond and also the corporate bond. Get what I mean, eh? We are to discuss first of all, we are to discuss the different types of the debt instruments. When we are done discussing in terms of risk, in terms of return, in terms of maturity, and what? And the liquidity. Then we are also to compare between a government bond and a corporate bond. That's part B of the question. All right, let's go. What are the common types of the debt instruments in the bond market? Number one, we have what we call government bonds, isn't it? This is a debt market. The bond market has the instruments called government bonds. You know, the government bonds, basically as we already said, these are bonds that are issued by the what? By the government. Okay. In terms of risk, usually there is a lower level of risk, and the return is also low. You get what I mean? Eh? With the government bonds, the return is a bit lower, relatively low, and also the risk. Actually, they are said to be risky-free. All right? Yeah, they are said to be risky-free. Very low levels of risk. We have what we call corporate bonds as well. Now, these we said they are issued by what? They are issued by companies, yeah? Corporate bonds are issued by companies. In terms of risk, they have high risk, all right? The risk of defaulting is quite high, but also the return, when you look at the return, is high. It's usually high, all right? It's usually high. The government bonds, when it comes to liquidity, they are usually highly liquid, okay? I didn't make mention of that point, right? They can easily be sold in the secondary market. Back to the corporate bonds. The risk is high, also the return is relatively high, okay? When it comes to the level of liquidity, they are not highly liquid, all right? They are not highly liquid because, you know, they are not easy to sell on the secondary market, the corporate ones, because there are few people that may be interested because of the risk that it usually carries, right? They usually carry quite a lot of higher level of risk, all right? In terms of the duration, the maturities, yeah, they do differ, yeah? They do differ. You could have 2 years tenor, 3 years tenor, 5 years tenor, 5 years, 7 years, 10 years, and 15 years. Yeah, this was already communicated to us. We have another class of bonds on C that we call the municipal bonds. Yeah, the municipal bonds, these, you know, they are issued by local authorities, right? But usually these are tax exempt. They are issued by local authorities. Local authorities, like councils, really, they do issue bonds. This is not very common here. Yeah, but we have such bonds.
In Zambia?
Sorry?
Is it working in Zambia?
I said it's not very common in Zambia because even in the same government one, there are few people that are really participating comparing to the adult population that we have in Zambia. The level of participation is quite very low. I would just give you some very shocking statistics. According to the Finscope, survey, national survey of 2020, it was revealed that people that take, for example, participation in this formal crediting is standing around 35% now, which is a great improvement from 2015. Then participation in, for example, insurance is 2.5%, very low, somewhere around there. It's super low. In short, we are trying to say the Zambian population is not very active when it comes to the finance sector, really. Yeah, the citizens don't participate a lot. They're not very common, yeah. If they are there, but the law of the degree of consumption is quite very low. Yeah, because myself, I've not really engaged in them. I've never heard of these conversations so far being advertised like the ones for government. Yeah. Okay. Anyway, the whole take-home message is that we have the municipal bonds. Yeah, they are there. We also have other bonds that we call convertible bonds. Convertible bonds. Now, with the convertible bonds, these are issued, by either the government or usually not really by the government. These are usually issued by the corporations, but they have how should I say? They give you a chance to convert them into equity. Right? You can convert them into equity. You get what I mean? Eh? You can convert them into ordinary shares at some point. Like in case these guys default or delay to pay you, you can just convert all your money and convert them into ordinary shares. Then you become part of the shareholders. Those are convertible bonds. And we also have what we call zero coupon bonds. Zero coupon bonds. I'm talking about the types. The question is requiring us to discuss different types of instruments that are used in the bond market. Zero coupon bonds. With the zero coupon bonds, colleagues, there is no periodic interest that is issued at a discount. Nothing. Sorry, there is no periodic interest really that is. How should I put this? No interest like coupons. There, oh, sorry, no coupons. No coupons. No coupon. It's not like these other bonds where you're receiving periodic coupons, but there are no coupons. But usually they work like the treasury bills. Remember the conversation around treasury bills that we talked about? We said that treasury bills are usually issued at a discount. So for example, if the face value is 100, then they are issued at, say, for example, 70 kwacha each, which means you pay 700 to buy 10 bonds, 10 of such bonds. Then at the end of the period, you get the face value of 100 each by 10, that's 1,000. So you just get 1,000. You spend 700, then you get 1,000. For example, I'm just giving you an example. You buy them at a discount. Then after the end of the period, the maturity, when they mature, you get, the price you paid plus that difference value. In short, you get the face value. That's all. Then the difference between the face value and what you paid is your gain. Yeah, I think these are the main ones that I've highlighted. If there are still more, you can go and do your own research. Please, you may have others. I've talked about government bonds, corporate bonds, municipal bonds, convertible bonds, and the zero coupon bonds. Okay? The question is not yet done. The question says we should talk about, compare, between the government bond and also corporate bond. Let me start in terms of risk. In terms of risk, government bonds have low risk. You know that, we already said this. there is low risk. But these usually there is high risk, right? We can still compare in terms of return. In terms of return, government here, a corporate, all right? In terms of return, government, there is usually lower return, though safer, but it is usually they give higher return. Why should they give you higher return? Because they are compensating you. You are being compensated for the risk. In terms of the maturity, for the government, they usually range from short term. I already talked about those different tenors up to the long term. But usually when you talk about the corporate bonds, these are usually medium term. Yeah, most of them are just usually medium term. 5 years, not really 15 years, you know, many years, not really. Liquidity. In terms of the liquidity, okay, these, they have high level of liquidity, meaning you can easily convert them into cash, right? Because I told you that the government ones can actually be sold even on a secondary market. But when it comes to these corporate ones, the level of liquidity is quite moderate. Yeah, it's moderate. Why do we say it's moderate? It depends on the company itself and how much confidence that the consumers have in that particular. So this is the message that we are sending across. Any questions? Yeah, you could also add that the government ones are issued by the government and the corporate bonds are issued by the corporation. Those are the main differences, right? We have done a bit of comparisons. Then you can add some more salt and sugar. And then, yeah, you make it good. All right. Question number 1C is reading, and I am reading in your hearing. The company is analyzing a corporate bond. And this corporate bond is actually issued by a well-rated manufacturing company. Now, it is considering how, you know, that is the team, how changes in interest rates might affect the bond's price. So the face value of our bonds, face value is what? Is 1,000. The coupon rate is 6%, and maturity being, you know, 5 years. And then the price, that's the price you're paying. It is currently trading at $9.50. That's the price. Okay, that's the price of the bond. What is required? Number 1, C1. Question 1C1. You are to calculate the current yield and the maturity to, you know, a yield to maturity for the corporate bond. Basically, that you have to show your calculations and explain how these metrics actually help investors assess the attractiveness of the bond. So we want to calculate the current yield and the yield to maturity. Before we start doing the calculations, is the class with me? Can you hear me clearly? Is there any question from anybody? Am I audible enough? Can you see the screen? Anyone to just confirm on our behalf, really, so that we progress? The work is still quite a lot.
Getting you.
Oh, thank you. So now let's come to current yield. The current yield, colleagues, is basically the annual coupon. It's just annual coupon divided by current price. Nothing much. You just do annual coupon divided by current price. That's the yield, the current yield. So what is our annual coupon? You need to do the percentage, which is the coupon rate, times the face value, right? So our face value is 1,000, 1,000 multiplied by 6%, 0.06. What do you get? 0.06, that's 6% multiplied by 1,000. What is the annual coupon, for this bond? It's a corporate bond.
60.
Yeah, 60 to be divided by the price of this bond. What is the price of this bond? The price of the bond is currently 950, right? Can you do your divisions? And what do you find as the current what? Current yield. What's your current yield? Just say 60 divided by 950, you should be fine. 0. What? None of us has a calculator. 0.0 what? It should be 0.0 something, because I mean 950 is too big. Anyone to just help us quickly so that we move on,
0.063.
0.063, all right? Which is approximately 6.3%, right? If you multiply it by 100 as the current yield. Okay, we are not yet at the point where we're explaining how the metrics are used, but we are calculating. Let's go to the yield to maturity. Now, here is your formula for the yield to maturity. Now, looking at this bond is redeemable. It's a redeemable bond. All right. So if you want a yield to maturity for a redeemable bond, this is your formula. It is actually the coupon, right? Plus C, look at that. The face value minus the price of that bond divided by N, which is actually the number of years. This is 1. Everything divided by the face value plus the price. This is a redeemable bond over 2, because this is the denominator is to be averaged, basic. So we are good. Nothing much, nothing little. What is our coupon? Our coupon for the bond we already know is 60, yeah? Because the coupon is basically coupon rate times the face value. 6% of our face value is 1,000. What's the coupon rate? Our coupon rate is 6%. 6% of 1,000 is 60. So our C is 60. Open the bracket. What is our face value is 1,000, yeah? Minus the price of it, the share is, not the share, sorry, the bond is 950 divided by 5 years, okay? And everything to be divided by, what is the average? 1,000 plus the, I think, face value is 1,000. 1,000 plus the price. This will be 1,950, yeah? If you add 1,000 plus 950, 1,950 divided by 2. Give me that figure. 1,900 divided by 2. So that you can find what?
975.
975. So you have 60 plus, 1,000 minus 950 is 50 divided by 5. I think this should be 10. 10 over, you said 9 what? 975?
Yes.
This should be 7 over 975. Yes, just that. And you do your computations. What do you find? What is your yield to maturity? Yield to maturity is equal to 70 divided by 975 is 0. What?
0.071.
718. All right, somewhere there, 72. Then when you multiply by 100, we should find 7.1%, right? As a yield to maturity. Are we good? We come to interpretation. Are we good? Oh, we assume that the silence means we are good. Then basically this is how we find the yield to maturity. And we need now to pass comments. And our comments, we are told to also say how, these rates affect the bond price. What you should know is that there is the key message is that there is a negative relationship between a bond price and the interest rates. All right. When the interest rates rise, usually the bond prices go down. Okay. All right. Okay, then we can easily, what else now is there to talk about? So the current yield, it shows the return that is based on the current price. And then the other one shows the return that is actually based there. That is if you hold the bond until it matures. Okay. Of course, that still accounts for price, which is basically capital appreciation. We call it capital appreciation. Okay. Question number C2. Discuss the relationship between the bond prices and the interest rates. What is the relationship between the bond prices and the interest rates? That's part 2 of the question. Okay, I think I've already touched a bit of this relationship, just a bit. What did I say? What did I say? You remember? Oh, you are
There's
not
an
able to
inverse relationship.
Exactly. There is an inverse relationship, which means when interest rise, what happened to the bond prices? The bond prices do what? They do fall. Yes. If interest rates rise, the bond prices should fall, and vice versa. When the interest rates fall, the bond prices do what? They go up. Yeah. Why should that be the case? Why should that be the case? Why should that be the case? Yeah, that's how the question should be phrased. Why do you think that should be the case? Okay. All right. When you're participating in the financial market, the bond market, to be very specifically, there are new bonds that are always issued, right? If you take the prospectus that I showed you from the Bank of Zambia, for example, there are those, they are what you call benchmarked bonds and unbenchmarked bonds. Remember, the benchmark bond, you should just go check the prospectus. So there are new bonds that are always issued, right? So the new bonds will offer higher yield. You understand, right? Since the interests have gone up, the new bonds that will be issued now, they will give higher yield, making existing bonds with lower coupons less attractive. That's why their prices will fall. So you are speaking fast. We are not getting on that part. You can slow down. All right. Let me go over this. You see, the bonds keep on coming on the market, right? Now imagine you bought a bond 5 years ago, right? Or maybe 2 years ago. Then the interest rates along the way, remember we told you that the interests are determined, the interests of the bond or the coupon is determined by the market, right? Imagine after you have already bought your bond 2 years ago, maybe a 5-year bond, then the interests have gone up. What does that communicate? It entails that these new interest rates, these new bonds that have come, people suggest higher interest for them, right? Because the interests have just gone up in general. So in short, they'll be giving higher yields. So new bonds will be more attractive than your old bond, the one that you bought 2 years ago, many years ago. Why? Because your bond gives a very low level of interest rate or coupon. Remember, coupons are fixed, they are not adjustable. Whether there have been changes, you know, it is fixed where you agreed there. So what will happen is that you remember your bond is your bond coupon is fixed. So people will say, no, your bond, I mean, is not giving higher rates. They would rather go for these other new bonds. So since your bond is less attractive, yeah? Since your bond is less attractive, the older bonds are less attractive, then their prices will go down. Have you listened now to the explanation? Obviously, you have now understood how the science works. So the investors will require, you know, a discount on older bonds to match the market yield. That's what will happen. The investors will say, no, we can't buy this bond at the face value. No, it doesn't make sense. So they'll even require the bond to be sold at a discount at that point. That's how the bond market does work. Okay, if there has been a change. When you sell it in a secondary market and the interests have gone up, the average interest rates, just know that if you are selling your bond on a secondary market, on the Lusaka Securities Exchange Bank, on the bond market, that simply means you sell your price at lesser than the face value. Okay, that's what usually happens in practice. Okay. All right. Now let's move on. Let's move on to part 3 of C, question C3. Question C3, it is reading, and I am reading in your hearing. Explain how an increase in the market interest rates might cause the price of this corporate bond to fall, and how the bond's duration can affect the. I mean, I think this is the same question that is being asked again and again, isn't it? It's the same question that is rephrased, but anyway, let's go on. Only that we have added the duration part of it, right? Don't worry. Let me explain read the question one more time. Explain how an increase in market interest rates might cause the price of the corporate bond to fall, how the bond's duration can affect the, you know, the price sensitivity to interest rate changes. Now listen. When the bond price fall, for example, the influencing, which one is an independent variable now? Between bond price and the market price, interest rates. Which one is an influencing variable? The independent variable is the interest rate, right? Yeah. So when the interest rates rise, we start from the independent variable. So when the interest rates, you know, rise, what will happen is that you know, the bond prices will fall. Why? Because the fixed coupon will become less attractive. Why? Because the fixed coupon, there is a fixed coupon, 6%, for example, in that one, 6% for that bond is less attractive. Why is it less attractive? There are new bonds that are giving higher returns, right? Higher yield. The bond price must fall, therefore. Why? Below the face value, so that it can have some competitive rating. That's what really happens. People would demand to buy this at a lower rate. I've already explained this. It's like I'm just now saying the same stuff again and again. Okay, but I had not yet touched in the previous question, C2, I didn't touch the bond duration, how that really affects, all right? How does the duration really affect? Now listen, the higher duration, the higher the duration, that is the tenor. The higher the tenor, the duration, all right? Usually the more sensitive the price of the bond becomes, right? Price of the bond becomes. You get what I mean? the price of the bond will become very sensitive. Why should it become very sensitive? Why? Because, I mean, its long period is so risky. You understand? The risk is high. You know, what risks do we have? There is inflation. There is also changes in interest rates. So investors that are informed in this field or in this conversation, they know that I buy a bond, let's say, for 10 years. What if interest rates will change in 10 years? What if inflation, will sweep all the return that we have? You get what I mean, eh? Because inflation has power to sweep all your gains. Let's say, for example, what's this? Your inflation stands at 15%, and then your bond is just giving you maybe, let's say, 10%. Huh? It means that your inflation will be able to sweep all the return that you get from the bond. You get the point, right? It means that you will be able to get more money, yeah, like nominal values, looking at the money, but the purchasing power, you know how to measure inflation. Inflation is basically the pour in the purchasing power of your currency or of your money. So your money will be matching just by looking, but it will not be able to buy a lot of things. You get what I mean? After that long period of time. So that's why investors don't want to invest for a very long period of time. It is not usually advisable. It's less attractive, those very long periods. So at least the 5 years bond duration is usually moderate, this one, or lesser than 5. Most of people go for 2 years, 3 years. At least in 2 years, if there will be changes, I think, in the economic environment, the changes in the economic environment may not really be very much. You understand, right? Yeah. You may be able to make some adjustments before those changes become super detrimental, to your investments. Longer duration bonds, I've already said that they usually experience a greater price decline when the interest rates rise. That's what usually happens. Because, I mean, looking at the period, it's not now. People want things now, and, the price should just fall. We should buy it at a very low price so that at least at the end, we receive the face value plus the coupons, we get something. So people push the prices to be down, like super down, as they really negotiate and conversate. Okay. Quite an interesting conversation, right? The conversation of the bond market. I think this essay, what is this? This assignment is quite practical. I love it. Obviously, you enjoyed the conversation. Yeah, it's quite practical. I think these are the same stuffs that we were talking about when I took you to the Bank of Zambia website just to explore the bond market. All right.